Will keep joining. So, yeah, ready?
Yes, please.
Great. Okay. Good evening, everyone. A very warm welcome to today's webinar on navigating the income tax transition from the 1961 Act to 2025 Act, which has been released recently. This webinar is organized by LEXCOMPLY Learning. It is a dedicated training and skill development vertical of LEXCOMPLY Global Compliance Management. For those of you who are new to our ecosystem, LEXCOMPLY is a pioneer in the eGRC space, providing world-class compliance management solutions. We are proud to support over 400 enterprises across 24 countries and have a global community of more than 25,000 compliance professionals who rely on our tools to manage their statutory risks and regulatory controls. So, coming to today's topic, with the change in the Indian taxation landscape that has happened recently, organizations are facing a paradigm shift. The new act isn't just a rearrangement of sections, but a complete overhaul of language, logic, and compliance structures. So in today's session, we aim to provide you with a clear roadmap to decode the shift from 1961 to 2025 Act, practical compliance
Mary navigating கீழே பாருங்க you are in பக்கத்துல joined event இருக்கு பாருங்க you are in அப்படினு இருக்கா
there is some disturbance on the line. Can people please mute their Thank you. So in today's session, we aim to provide you with a clear roadmap to decode the shift from 1960. I'm sorry, there's a lot of confusion, sounds on the line, some disturbance. Participants, can you please mute your speakers, please? Thank you. I will start again. In today's session, we aim to provide you with a clear roadmap to decode the shift from 1961 to 2025 Act, then practical compliance with a brief look at the revamped forms and filing timelines. We will also help you spot the roadblocks that are already challenging finance and legal teams across industries, and we will help you with a game plan for your organization. This is the aim of today's session. Now, let me come to our esteemed speakers. So to help us navigate all these complex changes that have come up in income tax, we have two distinguished experts from Kramer Consultants, which is a leading accounting firm and multidisciplinary advisory firm known for its hand-holding approach for domestic and international clients. So I welcome Mr. Manan Agarwal, who is a chartered accountant by profession and a partner at Kramer Consultants. Manan brings over 15 years of deep expertise in corporate and international taxation. He specializes in tax advisory, cross-border transactions, and litigation. Then we also have Mr. Dipanshu Manocha, who's a senior manager with Kramer Consultants LLP, also a chartered accountant. He plays a pivotal role in Kramer, managing complex tax compliance and regulatory frameworks for a diverse portfolio of clients. Manan, Dipanshu, the floor is yours.
Thank you so much, Jyoti, for the great introduction. I would now request your permission to share my screen.
Yes, please. I think you should be able to do it now.
Is my screen visible?
Yes, it is.
Great. Thank you so much.
No, it's gone. Manan, sorry, it's gone again.
Just a minute.
Yeah. No, the PPT. Just check it. Yes, visible now. It's gone again. It just came for a second. It's gone again.
Okay, the moment I'm doing it, in a slideshow mode, that means it's going.
Ah, okay. Slideshow mode is not working then.
Is it visible now?
No. Are you sharing your entire screen?
Yes.
Entire screen, it should work. Slideshow. Now your screen is visible. This is visible.
Now I'm clicking on slideshow. Let's try for one more time.
Yeah. No, slideshow is not working.
For some reason, slideshow is not working. Anyways, so shall we?
Do you want me to share from my side?
Yes, I think that would be great.
Yeah, just give me a second. I think I need to be made host for that. Just a second. I am. My apologies. Just give me a second. I'm just opening the file. It's a little slow on my end. Yeah, so I'm taking over the screen sharing. Please let me know if you can see my PPT. Is it visible?
Yes, yes.
Okay, great.
All right. So thank you once again, Jyoti, for sharing this platform. And we have around 15 slides, and I think about a total of 90 minutes, which are now 80 minutes. So we'll
Yes.
try to wrap up the presentation by maybe 5:30ish or something. And after that, we can have Q&A. So let's start with the topic right away. Could you switch to the next slide, please?
नितिन ज्वाइन नहीं कर रहे थे नितिन
हेलो
Jyoti, can you move to the next slide?
Yeah, I can't hear you. There is a lot of
मैंने जो लिंक
I'm just stopping the screen again.
दिया था
There's a lot of disturbance.
I think you need to mute all the
Please talking parallelly.
नहीं मेरा तो ऐसा कुछ नहीं आ रहा है
Give me a second, please. Sorry, I'll just organize this.
Sure.
This meeting is being recorded.
Yeah, apologies for the interruption. I'm back. I think now we'll have some quiet and yeah, Manan.
Yes. So, all right. So, can we start now? Resume?
Yes, please. Yes.
Great. So let's begin by realizing that this transition, the new Income Tax Act 2025, I mean, if we talk about the last 14 years, I think this is the fourth important transition which I have experienced. First was the 2013 transition from the old Companies Act 1956 into 2013. Then 2017 saw movement or a shift into the GST regime. Then November 2025 saw the shift from the labor and employment laws to the new labor codes, and now it's the new Income Tax Act. So it's interesting to see that finally something has come to implementation in the income tax framework. And if we try to trace the history a bit, we will realize that in 2008 or 9 approximately, the direct tax code was supposed to come in was supposed to come in India, but finally that never saw light of the day. That could be because of political reasons. Of course, we know that the current government came into power around 2012 onwards, and maybe because DTC or the direct tax code was an agenda of the government before that, and perhaps that did not happen finally. But now, finally, the Income Tax Act 2025 is up and in front of all of us, with us booking the hard copies of the act and running after the statute, the changes, etc. So, if we see, starting conceptually, that the income up till 31st March 2026 will continue to be governed by the 1961 Act, and all income from 1st April 2026 onwards will be governed by the 2025 Act. This is not the first transition over the last approximately a century's time that is happening in the income tax code. So earlier it was 1922, the Income Tax Act 1922 moved into the 1961 regime, and at that time also the Income Tax Act 1961 had a specific provision for the transition, because mainly it is a period of around 1 to 2 years of transition. Whenever a new law comes into play, it's the first initial 1 year or so which is usually difficult for the industry. So, but in the matter of Income Tax Act, we see that this is happening for the second time in the last 1 century. So when the Income Tax 1922 transitioned into the 1961 Act, there was a specific provision in the 1961 Act which talked about the transition, and it talked about 13 odd situations of how to manage the transition, which now, Jyoti, is it possible for you to mute the participants?
Yeah, we'll have to participants. Can you please mute yourselves, please? Manan,
Now,
please.
all right. So now in the new Income Tax Act also, we have section 536, repeal and savings, which gives, which talks about 22 particular situations, how the transition is to be managed. This is supported by the FAQs, which was issued by government last month, a set of 262 FAQs, which acts like an SOP, I would say, for transition into the new law. So these FAQs, along with section 536 of the new act, it helps us in understanding about 80 to 85% of the transition or clarity in terms of different matters. Will you move to the next slide, please? Let's have a look at the key changes in compliances. Those compliances which have an impact across all the industries and all the taxpayers. So the first column and the first point, if you see, is employee claims for deductions and exemptions. Earlier, it used to be Form 12BB, in which the employee had to give the declaration to the employer about the tax-saving investments it will make throughout the year. Now it has been replaced by Form 124, which is applicable from April 2026 onwards. And there have been some new fields which have been added, like the mandatory declaration of landlord-employee relationship. This, we know that most of the industry, most of the salaried employees, in fact, they used to show the rent paid to one of the relatives. And this is something which has been in the notice of the government for a very long time, but due to many political reasons, the provision had not been done away with. In fact, the new regime had come, but the provision relating to rent paid to relative, it was not attacked directly by the government in any manner. Any which ways, coming back to the new Form 124, it is now mandatory to declare the landlord and employee relationship in the declaration. The rent agreement is mandatorily required. Frequency is annually, of course, which continues to be the same as last year, or as the previous act. And there is a penalty basically on misreporting by the employee of 200%. So please be very careful when you are submitting your declarations to the employer. Ideally, it is not something which lands in the hands of the income tax department on day one. But of course, in course of scrutiny proceedings, if required, then the employer can always produce the same. Second point, a second row on the screen you see is about TDS certificate, Form 16. This term had become so synonymous that people hardly used to say TDS certificate on salary, but Form 16, and everybody knew what Form 16 is. Now we have to change our habit and call it Form 130. So a major shift in the commonly used forms that we used to talk about will now have to be made deliberately and consciously. So Form 16 will be required to be issued by 15th June 2026, the old form itself, for TDS on salary during financial year 25-26. But the new Form 130 will be required to be issued by June 2027 for tax year 26-27. And if we talk in terms of the changes, so now the Form 130 has 3 parts, which earlier in Form 16 used to be 2 parts only. And the default regime, of course, is the new regime. This is nothing new, but just a very important point relating to salary taxation. Could you come to the next slide, please? Form 16A, which is the TDS certificate on non-salary payments issued on a quarterly basis. So 15th June 2026 is the last day when we'll see Form 16A being issued for, again, financial year 25-20, for the quarter Jan to March 2026. And for the quarter April, May, June 2026, the new Form 131 will replace the earlier Form 16A. And in terms of the changes, the payment codes have come ranging from 1001 to 1092, and certain additional details like TDS rate and contact number and email ID of deductor needs to be given. Second row on the screen that you see relates to TDS challan. So now ITNS 281 is no longer in play. It's 281N, which has succeeded it, I would say. And the new challan has section-wise payment details, and a maximum of 20 codes can be mentioned in the new challan. We'll see in the next slide the screenshot of the new 281N challan. Could you come to the next slide, please? Here is a snapshot of the new ITNS 281N for those of you who have not yet filled it for the month of April. So you can see on the left hand side within the red box, now you have to select the residential status of the deductee, resident or non-resident. And within the right hand side, the red box that you see, there is a drop down menu. You got to select the code in that for the payment of TDS. Next slide, please. The drop down menu, this is what it looks like, the different provisions, I would say. Now the table is there in section 393 and the references are there, so you can select and proceed accordingly. Could you please move to the next slide? The quarterly TDS return on salary form 24Q. So again, Jan to March is the last quarter for which form 24Q will need to be submitted. And thereafter, for the quarter April to June 2026, the new form 138 will need to be submitted. The new form 138 requires more detailed employee-wise transactional data, and it is also integrated with the Traces portal. Second row that you see on the screen is the TDS return on non-salary payments to residents, form 26Q, that has now been replaced by form 140. Form 27Q, the third row that you see on the screen, is now replaced by form 144, and the quarterly TCS return 27EQ has been replaced by form 143. Could you please come to the next slide? The period time limit for revised TDS return has been reduced to 2 years from end of relevant financial year, which earlier was 6 years. One very important change is regarding Form 10F. So I don't know how many of you deal with cross-border taxation, but this is basically the information which a non-resident needs to submit with the Income Tax Department of India. So you might be making payments to overseas parties for which you might be asking the overseas company to produce a tax residency certificate, no P certificate, and till now Form 10F. But now that has taken the shape of Form 41. So this legally, if we go strictly by the provision, so earlier Form 10F used to be required to be filed only if certain particular information was not mentioned in the tax residency certificate of the home country. This is you can see these information in the right hand side column, the tick marks, name of the assessee, status of the assessee, country of residence, the TIN number, residential address and proof, residential address and period. So earlier, before 31st March 26, the law said that if all these information, all these are mentioned in the tax residency certificate issued by government of the home country of the overseas payee, then Form 10F is not mandatory to be required to be filed in India. This is what the law said. However, practically, we used to get the Form 10F in all cases. But now there has been a shift to the extent of saying that even if all these information is mentioned in the in the tax residency certificate, still Form 41 will need to be filed in India. So for financial year 25-26, the form that needs to be filed is 10F, and for financial year 26-27 or tax year 26-27, we need to submit Form 41, and this can be filed by the overseas company even if they do not have a PAN in India. One important change in Form 41, the second bullet point that you see in the right hand side of the screen, the change remarks column, it requires 2 additional details. One is email ID and contact number. We won't go much into that because that's a pre-filled information. The other interesting change which I noticed is that now Form 41 asks for the communication address in India of the overseas entity. This is not something which used to be asked in Form 10F. I don't know why the government has inserted this in Form 41. What is the intention behind this? To me, it's not very clear. Is it? I don't know. But is it a way for government to interpret this information for constitution of permanent establishment in India of the non-resident payee, or any other motive is there behind it? I don't know. But till now, communication address was never asked by Form 10F, but Form 41 asks for it. So this is an important change regarding 10F to 41, which I think you should be aware of. All of us, whoever are making payment to overseas entities.
People in the background, can you please mute? There is some noise coming from somewhere. Can you please mute yourselves? Manan, please start. Please, you continue.
All right. Could you move to next slide, please?
Yes.
Then Form 15CA and Form 15CV. This again is relevant for all of us who are making payment to overseas pays. Form 15CA needs to be filed by the applicant who is making the payment, and Form 15CV by the chartered accountant. This has now been replaced by Form 145 and 146. Certain additional, very minimum changes have been made in the form. Last month, April, saw a lot of confusion with many banks because some banks were accepting Form 15CA, some were accepting Form 145. Some were accepting both, strange enough. Though there was clarity provided in this in the FAQs issued by the government in March, but different banks were practically following different approaches. So if we see, it's very interesting to note that the requirement of Form 15CA CB emanates or originates from the income tax law, it is something which perhaps maybe should have found place in the RBI law, because it's usually the banks who insist on this. So some kind of interplay or connection between Income Tax Act and FEMA, I don't know whether it's required or not, but because of the requirement originating legally from the Income Tax Act, but practically being insisted on by the different AD banks, some issues were there. Now here also different AD banks have been using different approaches, but again, since this is a matter of month of April itself which is passed, so I don't think there's any point of deliberating upon it further. Now, as of today, as we speak, most of the banks are easily accepting Form 145 and 146. So we can, I think, move to the next slide. Form 15G, 15H, the declaration which used to be given for non-deduction of TDS, has now been replaced by Form 121. The tax audit report for in 3CA, 3CB, 3CD, for which the due date is still 31st October 2026. For financial year 25-26, these forms will continue to be submitted. But for the current financial year or tax year, for which the filing will become due sometime around October 2027, the form to be used will be Form 26 and not 3CA, 3CB or 3CD. Also, another important change that practically we are seeing is, it's not there on the slide as we speak, but Form 60 has been replaced by Form 97. So the Form 60 used to be given in case of an applicant not having a PAN, a declaration to be given by an applicant who doesn't hold a PAN. Now that has been replaced by Form 97, and there are certain changes in it. So last month we saw practically that there were issues with the bank also. Some banks were accepting Form 60, some were insisting on 97, and some were saying, give me both. It will be processed internally, whichever gets accepted, it's your luck. So these kind of transitional issues have happened in the last month. Maybe some of them are still happening, but as time progresses, things will settle down for sure. Could you move to the next slide, please? Now we talk about the key changes in employee taxation, for which I will request my colleague Dipanshu to take it ahead.
So, considering the employees' taxation, there are few changes have been made in the Income Tax Act 2025, along with the Income Tax Rules 2026. The first key change is the interest-free loan threshold has been increased to rupees 2 lakh. Earlier, it used to be rupees 20,000 only. It is a yearly benefit. That is we have to consider on yearly basis. The next is the key change belongs to meal allowance exemption. Earlier, it was used to be only 50 rupees per meal. Now it has been increased to rupees 200 per meal. Both the exemptions are available in old regime and new regime as on date. Earlier, the gift vouchers used to be taxed up to used to be exempted up to rupees 5,000 only. Now the limit has been increased to rupees 15,000 on annual basis. in case of old regime, these new children education allowance has been increased to rupees 3,000 per month per child. From earlier, it used to be rupees 100 only per month per child again. Again, the hostel allowance has been increased to rupees 9,000 per month per child from rupees 300 earlier. These two benefits are available in case of old regime only. And the last one changes belongs motor car perquisites. Now, as you can see on the screen, in 1961 Act, based on the capacity of the engine, the perquisite value was defined, such as in 1961 Act, 3,300 rupees per month, and in case of now it has been changed. The income tax in case 2025, rupees 10,000 per month will be the perquisite value. So, can you please move to the next slide? Yes. From HRA perspective, now 4 more cities have been covered under 50% category of HRA calculation. New cities have been added are as Ahmedabad and Bangalore. Earlier there was 4 cities: Delhi, Mumbai, Chennai, and Calcutta. Now 4 more cities have been added. For considering leave travel concession, earlier there were used to be many restrictions for claiming the benefit of leave travel concession. Now these restrictions have been removed. Now the employee only has to submit the evidences of expenses and the benefit will be available. It is available in case of old regime only. Further, I have to add. Please move to the next slide. Regarding the maintenance of books of accounts, now it is mandated to maintain to keep the electronic books accessible in India at all times. Further, the assessees who are keeping their books of accounts on cloud servers, now these backup servers must be located in India only. Further, the law says that books must be updated on daily basis. So these were the key changes which were made in 2025 Act, which are further cleared by Income Tax Rules 2026. So that's all from my side.
So basically, if we see a change in language, change in basically a simplification, no substantive changes in law as such, but the overall volume, if we see, it has been reduced by around 35% in terms of the act and the rules. And the language has been simplified. Provisos, subsections, provisos have been taken the form of subsections. And at certain places, this is leading to confusion also, and perhaps unintended consequences. So overall, compared to the more difficult transitions which India has already seen in the last few years, I think this is just a matter of time, maybe by another 6 months or so, that we'll all become accustomed to the new law. Of course, it needs to be mentioned that there could be many changes, amendments which we can see, which hopefully we will see in the new Income Tax Act coming into by way of amendment acts or by through the budget. And of course, it's very important that the new income tax website has been reframed, and it has now provisions of both 1961 Act also, 2025 Act also. So for the next, I would say 5 or 6 years or so, we will practically see both the acts running together. The question arises how. So if you calculate, I think the time limit for filing updated tax return for financial year 25-26, that is around 31st March 2031. So just imagine that you submit your an assessee who submits your updated tax return for the financial year 25-26 in 2031. After that, the notice is issued and the scrutiny happens as per 1961 provisions. So, realistically speaking, I think the next 10 years or so, we will see both the acts running parallelly. So I think this is it from our side. Of course, there could be a lot of things to talk about, but this is what the law generally says, the change or the changes deal with. And month by month, we will see the complications hopefully reducing further. So we had targeted 5:30, but I think we already completed it by 5:08. I don't know that's good or not so good, but I think we are happy to take up the Q&As, Jyoti.
Sure, I'll just stop sharing the screen. I think all the more time for us to have Q&As. So, thank you for such a comprehensive presentation on this topic. So we'll open the floor for questions. People who have questions, you can either raise your hand or put it on chat. I think we already received one question now. Just oh, somebody wants to see the form 10F and 41 slide again. I'll just show the slide. Sorry, Manan, which one was that? 41, 10F and 41. This one. Okay. I'm just sharing the screen. I think somebody has a question on that. So, this one. So what is the question on that? Whoever asked for 10F and 41, you can please unmute yourself and ask the question on this. Okay, till they come up. The next question is, can we select salary as well as non-salary payment code in one go?
In one go.
Yes.
Yeah.
Now it is possible in one challan, you can add salary TDS payment as well as non-salary TDS payment.
Okay.
Or on a max, you can select 20 various sections in one challan. The limit is 20. If you want to add more challan, then you have to create a new challan. In new challans, yeah, it's possible that you can add salary as well as non-salary payments in single challan.
Okay. Any other question? Okay, I have one from my team. So you spoke about Form 124 for employee deductions where rent agreement has become mandatory. So there is a 200% penalty there. So what is the onus on the employer? That the penalty, I think, is for employees, right? So what is the onus on the employers and how will they check whether that rent agreement is the validity of it, or is there any checks and balance there required?
So, see, the overall scheme of taxation, to answer that question, I think we need to understand the scheme of TDS, all right?
Yeah.
I would say that TDS is a sort of a responsibility which has been delegated by the income tax authorities to the industry, to the employers, basically, right? Employers are required to calculate the taxable income of the salary, the taxable income of the employees based on declaration to be given by the employees. Now, if the employees give an incorrect declaration, the employers should not be held responsible for the same. So that is the logic for which the penalty is on the employee if he gives an incorrect declaration. Of course, if he gives the declaration correctly and there is something, and then the TDS is calculated incorrectly by the employer, then of course the onus shifts to the employer.
Right. Okay. Great. What else? Yeah, one more question. Okay. Earlier, if we needed to pay TDS challan, we use sections. Why code now? That is a question.
If you see now in Income Tax Act 2025, there are two sections only, Section 392 and Section 393. But if you go to Section 393, it contains 4 tables. The table 1 is for payments to residents. Table 2 is for payments to non-residents. Table 3 contains details of both, whether it is resident or non-resident. And table 4 is for where TDS is not required to be deducted. Coming to table number 1 for an example only. In table number 1, you will see payments to residents having many serial numbers, which is not easy to memorize. If you can show me the screen of the challan, you can see there is section 393 and then table 1 and serial number. Because serial number is not easy to memorize, that's why the government introduced payment codes. On the basis of payment codes, you can easily select the section in which you want to make the payment. For example, payment code 101 and 102, 1001 and 1002 deals with payments for salary for government employees and other than government employees. Another example can be 1023 and 1024. That deals with payments to contractors. In case of 1023, the rate is 1%. In case of 1024, the rate is 2%. So for easiness, I guess the government has introduced payment codes because it is difficult to memorize the section.
Okay, thank you. We have one more question. Why has the Form 41 filing been made mandatory in ITA 2025 if TRC containing basic information, unlike in ITA 1961?
I think that's a very interesting question. So I think government needs to have the access of the TRC. All right. As you know, the income tax return form does not allow any attachment to be uploaded. Okay. So for an assessee who is claiming the benefit of of double taxation avoidance agreement, how will the government get hold of the TRC? What is the means for government to have access to the TRC? Until now, only if scrutiny proceedings were initiated, in that situation, government could have insisted an assessee to produce TRC, but not by default for all the assessees. So making it mandatory to file Form 41 enables the government to get hold of the TRC and hence have the necessary data with it to check later whether the assessee deserved to avail the benefits of DTA or not. So I think that is the reason why which government has now mandated it to file Form 41 to get hold of the TRC.
Right, that makes sense. Okay. One more question. When all the TDS information is available in AIS, is it mandatory to issue TDS certificates?
Yes, as per the income tax law, it is mandatory to issue TDS certificates. In case of new forms like for TDS on other than salary, the certificates has to be issued within 15 days from the end of the month in which the return was filed. For example, the return is required to be filed by 31st July, and you have to issue the certificates by 15th of August. It was just an example for the non-salary payments. So it is mandatory to issue TDS certificates as per law.
Okay.
Further, the employees will ask for form. Earlier, they used to ask for Form 16. Now they will ask for 130 for filing their return of income. So it is mandatory for the employer to issue TDS certificates.
Okay. Okay. Next one. Do you anticipate the 2025 framework changing the threshold for employer due diligence expectations in withholding tax compliance and employee disclosures?
Once again, please, could you repeat the question?
So do you anticipate that the 2025 framework changing the threshold for employer due diligence expectations in withholding, tax compliance, and employee disclosures?
I need the question to be
It's
simplified, to be honest.
it's quite a long question. So basically, I think what they're asking is in the new framework. So if we change the threshold for employee due diligence, sorry, whoever has written this, can you please reframe this question? I think it's not coming out clearly. Can you please type again? What due diligence expectations are we talking about, please? I'll move on to the next question. Can we use unconsumed challans of old ITA into the new ITA?
Yes, as per the if you go through the 262 FAQs provided by the government, you will see that yes, it is permissible that you can consume unconsumed challans of 1961 in new forms, because that's a right of the employer. The employer has already paid it. It is possible.
It's possible. Okay. Then can we allow monthly vehicle reimbursement mixed use as 5,000 per month, which was 1,800 earlier?
Sorry, can you please repeat?
Can we allow monthly vehicle reimbursement for mixed use as 5,000 per month now, which was 1,800 earlier?
Yes, based on the employee. Suppose an employee holds a motor vehicle, then this exemption is this perquisite, I will say, is available in both the regimes. Yes, if the employee holds a motor vehicle, it is allowed. You can allow.
Okay. Coming back to the earlier question, which I was asking on due diligence. So the question is from an employer compliance perspective. So will the 2025 framework increase the level of due diligence expected from the employers into 3-4 areas: withholding tax compliance, validating employee declarations, payroll governance, and maintaining supporting documentation? So in these areas, is the onus of due diligence more on employers?
I think that's a very interesting question. So, if in my view, if the income tax department cannot expect the employer to be an investigation agency.
Yeah.
Right?
Yeah.
Basic due diligence, yes, it's a job of the employer because it is a responsibility, not authority. It is a responsibility which has been delegated by the income tax law of India. But investigation should not be expected from an employer. And I think to this extent, it continues to remain as the old law. But of course, if somebody, this is something the time will say, if basis on the newer additions made in the employee declaration forms, maybe tomorrow the government starts issuing notices to the employers, alleging a lesser amount of due diligence. But so hopefully this is something which the time will say. But in my understanding, I don't see much of a shift from the 1961 Act from this perspective, from employers' responsibility to do a due diligence of the declarations given by the employee.
If that is the case, it will be a relief to the companies. Otherwise, they're about to get scared on how to investigate these things.
Yes.
So, okay.
We
have time. Sorry?
In that situation, I think employees will start dreading the employer more than the income tax department.
Yes. The shift will happen. So, okay. So, we'll take a few more questions. We still have a little time. So, it's good to have more questions. Can new TDS challans be used against different sections, like 194J be used against 192 or other sections?
New, I guess they have mentioned the earlier 1961 Act. The new sections are different. 393. I guess they want to ask whether they can use contract TDS on contract challan for TDS on professional. For the setting of the tiered liability of TDS on profession. Yes, earlier it was allowed and now it will be allowed. As per
it will be. Okay. Yes. Then you mentioned that all three forms, like Form 3CA, clubbed into one form. The contents in the new form are as per all three forms, or is it simplified?
The content is more or less same in Form 26. There are few more declarations as will be given in the Form 26, such as the accounting software which is being used by the assessee, and the accounting software and the qualifications, the statutory qualifications, and the IP address of this assessee, and these kind of additional details will be required. But I guess the more or less the information will be same in Form 26.
All right. Okay. Anybody else? I think that's all the questions we have. Great. I think we are done with the questions. Shall we move on to wrapping up? I think I have received one more question. When the backup is maintained at headquarters outside India, how to handle the situation?
Now they have to shift to India.
They will have to shift to India.
Now it is mandatory required to be maintained in India.
Maintained in India. Okay.
They can have a different backup there for safety purpose, but in India it is mandatory required.
It should still be here. Yeah. Okay. Then one clarity needed on intersection use of TDS challans. Can salary challan be adjusted against non-salary challan?
So this is an interesting one. So if you create a challan, then it will allow you to create a challan with salary as well as non-salary payments. But I guess you should not adjust a salary payment towards non-salary payments, because the returns are different for both the forms, both the challans. So it is recommended to not adjust between two returns. But you can adjust within the different sections, like in case of non-salary payments. You can adjust for professional and contracts, but not with salary, or it is not advisable from our point of view.
The structure itself is different, no? So that may cause confusion only.
Yes.
So, okay. Is there any change into penalty or fines in new ITA due to non-compliance? Any impact on penalties?
The penalties, more or less, in some cases it has been increased, but more or less they are same. But in some cases, the imprisonment has become mandatory. In 25 cases, to be very honest, the imprisonment has been become mandatory. So we will see.
We'll see. Yeah. So to that extent, it's become more stringent. So yeah, but going forward, we'll see how they actually implement this. So time will tell, I guess. So okay, we are closing the questions here. I will move on to the next summary. So thank you so much, Manan and Dipanshu. This was a very amazing session and a very comprehensive breakdown of what is required under the new law. So to put it simply, I think this move of the new Income Tax Act is all about making life easier for the taxpayer to some extent. So by raising tax-free limits, removing redundant jargons, I think that was one of the big concerns earlier, and then slashing the number of rules and forms, of course. So I'm hoping with this we are moving to a compliance-first culture, which is more streamlined for companies as well. As we conclude, I would like to extend a huge thank you to Manan and Dipanshu and Craven Consultants LLP for sharing their time and expertise with us. It has been a very insightful session, and you've managed to make a complex transition feel manageable. To our viewers, thank you so much for your active participation and questions. We hope these insights help you prepare your organizations for the road ahead. And at the end of this, once we close the session, you will all receive a feedback form, and we would request you to please give your feedback or your thoughts, drop your thoughts, so that we can bring you more and more interesting webinars in the future. And also, this session has been recorded, and the recording will be available on LexComply's LinkedIn page shortly. in a couple of days, and you can sort of revisit and listen to it again. So have a great evening, everybody, and happy complying with income tax law.
Thank you so much.